Three, two, one, Q.
Hello and welcome to BQ Primo. Very good morning to all the viewers. I'm Hiral Dadia. Overall, a lot of movers and shakers in trade today. And if you see, in terms of a market score, let's quickly pull up the Sensex as well. We're seeing marginal gains of around 93 points coming in there. And if you see in terms of Nifty 50 as well, slightly muted moves is what we're looking at. We're pretty much at that 18,600 mark. Joining us on the show is Mayuresh Joshi to discuss individual counters and stocks that are in focus. Good morning and welcome to the show, Mayuresh.
Morning, Hiral. Pleasure to be on your show.
Always a pleasure to have you. Mayuresh, let's start with the life insurance companies. You have their revenues fall around 4% in the month of May, but two companies that actually stand out is SBI as well as LIC. SBI of 58% growth, whereas LIC has seen a decline of around 11%. What is your view, firstly, on the sector, and two, specifically on both these counters?
To a large extent, life insurance companies have underperformed. The changes that have been tweaked, specifically from the income tax rules perspective, obviously that is going to create a dent in a few of these companies, and a few of the managements have put that on record. Companies like an HDFC Life, Max, because of their product mix, will take a hit both in terms of top line and bottom line as well. Now, the quarter ending March, I think the numbers were relatively better. I think a lot of investors were probably looking at tax saving as an option for this financial year. With rules substantially changing for the current financial year, I think a substantial portion would have happened. But the new premium growth is a little bit softer. What you're probably seeing in terms of expectations on how the product mix will evolve with the new rules and regulations in place is, as I said, going to take a dent on the top line and bottom line. And therefore, I think out the entire pack, I think SBI Life is something that has held on. We'll continue holding on for these reasons itself. The product mix is relatively better. The overall expense ratio, including commissions, is in higher single digits, around 6 to 7 odd percent, which is relatively lower than most of its peers, which are around 18 to 22% as a band. Their bank insurance network through SBI and its branches give a huge impetus in terms of volume growth. And the value of new business margin with premium expected to remain stable can be relatively better and hold on in such scenarios where a product mix can evolve for a whole host of companies, creating further pressure in terms of both VLDs and the overall expense ratios. So looking at the data points, I think, and looking at the price strength on the ODE charts, and as we look at it, I think SBI Life probably stands out here.
Right. So overall, Mayuresh, would it be a good level to enter, or do you think someone has to wait to look at the counter if they've not bought it?
I mean, some price strength, some more price strength, but yes, I think the RS strength for SBI Life is relatively better, and the fundamentals, as I said, are relatively better than most players in the pack.
Right. Moving on, the power sector has been in focus as well. In fact, a lot of companies which are picking up steam as well in the last couple of trading sessions. And now you have India's peak power demand supply that has touched an all-time high. And this is on the 9th of June, around 223.23 gigawatts. What do you make of the power companies, and what would your preferred picks be?
So as you rightly pointed out, I think the heat wave which is continuing across the country, and the expectations if El Nino really plays out and monsoons get prolonged or delayed or deficient as well, I think the heat wave probably might still persist, which means that the expectations in terms of more consumption happening will continue for the entire power value chain. Having said that, I think all companies probably remain in focus across different time periods. I think it's generation companies, transmission companies, or power ancillary companies as well. In my opinion, again, I think being very selective in this space becomes paramount. We do have exposure to a few of the power utility companies. They've given big moves, but for compliance reasons, I think I'll not be able to take names out. For the generation companies itself, I think the expectations in terms of more renewables added as part of the overall capacities over the next few years, with more capex going towards these, is definitely going to have a huge impact over a longer period of time. Thermal capacities are still getting added on relatively, but the expectations in terms of coal costs coming up will mean that the expectations of an absolute and relative EBITDA as well should improve for these companies as well. A lot of these power ancillary companies, including transformers, you've got a few cable players, a lot of generators who supply to power companies have done well. So I think this space looks very, very interesting. I think the momentum can very well continue.
Right, and in fact, a lot of technical analysts are pointing out to a power grid that is seeing some good momentum from a charts perspective. Moving on, Mayuresh of a Maharashtra Seamless, they've gone ahead and prepaid a loan worth 234 crores. And this is a second prepayment if they've done, if I'm not mistaken, in the last 8 months. Coming out of their internal accruals, the company actually becomes debt free now. What's the outlook for this counter? Because in the on a YTD basis, a strong momentum that we've seen, a 50% up move on the stock price already.
I think the 650 odd thousand TPAs in terms of capacities for Seamless, around 55% market share, ERW around 2.5 lakh TPA, 18% market share. Expectations in terms of key clientele staying with them, revenues have held out pretty well. Margins have also held out pretty well. Expectations of margin stabilizing between that 15-16% mark is expected for Maharashtra Seamless. Yes, I think the large expectations were that debt will come off completely, which has happened. And that's a very, very positive indication for the overall stock itself. In terms of the capex that the government is probably doing, specifically towards ductile iron, ERW, Seamless, and the various applications thereof, I think more order wins can be expected for pipe companies in general and Maharashtra Seamless in particular within this pack. And therefore, I think strong order wins, revenue flow remaining strong, margin remaining stable, debt-free status means bottom line growth expected to grow even more stronger with interest stocks coming up on their balance sheet remains a few key positive attributes to the company. Slowdown in terms of capex spends, low margin orders remains risk. But in my opinion, I think capex spends will continue, at least from the government side and the private side as well, which should relatively hold out the earning strength for this company. So anybody holding on can hold on.
Right. So that's with regards to Maharashtra Seamless. Coming on, you have a Titagarh wagon that is in focus. Now, the stock actually is slightly under pressure today. However, the board has approved a proposal to raise almost 288 odd crores via preferential allotment to Small Cap World Fund. Now, along with the Titagarh, we were just analyzing the railway stocks, Mayuresh, and clearly they have outperformed the benchmark indices as well. If you talk about a Rail Vikas Nigam, 82% so far this year, which is leading the rail stocks. You have RITES, which is seeing gains of around 11 to 12%, Orcon around 40%, IRCTC slightly flattish. But overall, there is that momentum in terms of railway names already. Firstly, your view in terms of Titagarh, and moving on in terms of what should someone do with regards to the railway players, along with the kind of surge that we've already seen so far?
I think it's huge momentum generally for the railway stocks. I was reading a couple of articles where the electrification for India, I think, has improved quite significantly over the past 8 years. So out of the entire rail network that you've got, you're almost electrified 68 odd percent. So another 32% ought to go, but I think a lot more measures in terms of rail safety, what you've probably seen in the horrific accident, a very unfortunate one. Covered systems need to be implemented across the network as well. And therefore, I think a lot more is expected to be done for the railways, more orders coming through for a lot of these ancillary companies servicing the railways itself. And therefore, you've already seen a slew of orders coming in for companies like HVL Park or Coforge. KEC received a recent order of 600 crores. And so is for the electrification with a lot more orders coming in for the Vande Bharat network as well, which includes companies like Titagarh Wagons as well. So I think there has been a huge momentum shift as far as order wins are concerned for railway stocks. A little bit disappointing in terms of how future numbers are playing out. And valuations have also probably exceeded for most railway stocks in terms of their own standard deviations over the past 3 to 5 years and extended on the O'Neill methodology as far as price action is concerned. For Titagarh, I think it's a similar story playing out, almost 90% extended from its 200-day moving average. Anything which is more than 100% is a warning sign on the O'Neill lens. So it's very, very close to that. Order wins have been substantial for Titagarh. They're already executing a few orders for the Bangalore and the Pune metro. Wagon capacity is expected to increase quite significantly. 700 odd capex lined up to increase the capacity from 700 to 900 of 1,000 odd wagons per day to service the kind of expectations that Titagarh has to service over the next few years. They're also bidding in very, very aggressively for the Vande Bharat trains. And therefore, I think revenue growth can grow exponentially over the next few years. Margins have been relatively stable so far. Dividend yield has been okayish. But I think the entire perspective now becomes in terms of the valuation matrix on how most of these rated stocks.
Right. In fact, I was just going through the order book of three companies, Mayuresh, that's RVNL, Ercon, and Rights. Clearly, the order book to revenue ratio of these three companies is in that range of 2.3 to 3.4 times. And I mean, orders RVNL 56,000 crore order book versus a revenue of 20 odd thousand crores that they've done in FY23. Ercon is at around 35,000 crores versus a revenue of 10,400 that they've done. And Rights is almost double at 5,900 in terms of the order book versus a revenue of 2,500 that they've done in FY23. So clearly it's the, order inflow that's actually given these companies a boost as well. So let's see from where they reach from here on. But moving on, TVS Motor, that's another one to focus on in today's session. You have TVS Credit Services that have successfully managed to raise equity capital of around 480 odd crores from Premji Invest, and they will be buying additional equity shares for around 257 odd crores. Apart from that, TVS has also bought balanced 25% stake in e-mobility company, which is Swiss E-Mobility Group. How would you view this in terms of TVS?
But in terms of the EV ecosystem actually working in favor of the organized players should benefit players like a TVS. So the kind of launches that they've probably done in select categories, specifically I think the more than 250cc kind of category and the tires that they're probably doing, could also hold its product mix in good stead. So yeah, a huge momentum stock, a huge outperformer, but anybody who can clearly hold on.
Right. So that's with regards to where overall in terms of, a few of the names that we've discussed. Coforge is another one that is in focus. Mayuresh, they did have their analyst meet. Couple of interesting points that I was picking up from there in terms of where the demand goes. They've clearly indicated that they are not seeing any concerns there. They're confident of delivering a 13 to 16% constant currency sales growth, and overall a 220 to 250 basis points impact on a sequential basis on the margins on the back of the wage hikes. Now, overall, what do you make of this? Because clearly, if you see Nasdaq, it's already hit the August highs in terms of Friday's session. IT has started to see a catch up from the April lows, but there is something which is still missing there. How are you looking at mid cap IT players?
So strong performance, in fact, strong outperformance compared to the large caps. And a lot of management commentaries, Hiral, have surprisingly been very, very positive in lieu of the backdrop that we are expected to see in the second half, by expectations of the US recession expected to come through. The banking crisis mess that the US had at the beginning of the financial year can largely be expected to play out in terms of earnings profile. And therefore, how orders will play out is going to be a key defining factor. But most of these companies have probably indicated that client orders still expected to continue. Most of these companies are not in the discretionary spending category, and therefore I think there will be some dent, some impact when it comes to BFSI, which is almost 35-50% of the entire IT ecosystem, paired across counters between large and mid-cap ITs. And retail and manufacturing which account for 15 to 20% as a mix. So I think some dent can be expected, but a large consensus is of the opinion that order wins for mid-cap IT companies, which are between 1 and 5 odd billion, might very well continue. Because that is one last part that companies will want to probably take a hit on in terms of their entire automation and digitalization process. as well as they're carrying out. And therefore, I think the commentaries for Coforge have been extremely positive, as is for most companies within the sector, including the likes of an KPIT, a Sonata, an LTI, a Persistent, you name it. I think most companies have probably sounded very positive and optimistic when it comes for this financial year. A small dent, as I said, can be expected in terms of orders, but margins expected to remain stable. And therefore, I think anybody holding on to the stock price so far is above moving average on the real lens and above 2 as well, can continue holding.
Right, so that's with regards to Coforge as well as the mid-cap IT players. Go. Thank you, Mayuresh, so much for joining us on the show and discussing those movers and shakers in trade today. Stay safe and speak to you soon again. But clearly, overall, if you see in terms of where markets are concerned, no great momentum is what we are picking up in today's session. Clearly, there is some bit of frenzy confusion with regards to what comes out of the FOMC, I beg your pardon. And that's the reason why, we are not seeing a major direction in terms of where markets are concerned. So stock-specific action is what we are going to keep watching out for during the day. That's all that we have on this edition. Please stay tuned to BQ Prime. Lots more lined up for all of you on the other side. Thank you.